Well, hello everyone, it's me, Michael Reyes, a realtor in Chicago, and today I'm going to be putting together a video with Mr. Ktally regarding FHA 203K renovation loans. I recently took a course about this loan incentive, and I wanted to bring a pro in to give you an idea of how it works, how it benefits you, and what type of properties you can use it for.
All right, well thanks for having me in, Mike. I'm actually a military veteran, a graduate of West Point, United States Military Academy, many years ago, and I've been in the industry now for 22 years.
Oh, wow.
About 4 years ago, really started to make this the focus of my business, which is renovation lending, which is FHA 203K, and also the Fannie Mae Homestyle Loan. And there have been other products that have come and gone in the same time, but the basic premise of all these products is that it allows buyers and investors to buy properties and make them what they want them to be based on the after improved value of the home. So from a realtor standpoint, it's almost as if, well, we're trying to teach the realtors, do you want to take 3 clients out and show them 30 homes? They already know what neighborhood they want to live in.
Exactly.
They already know what size of home they want. They know what school district they want to be in. Yet you're forced, as a realtor in many cases, to drive around and show them 30 homes because the carpeting's wrong, the bathroom's wrong, the kitchen isn't the way they want it. And what we're saying is, well, you already know all those things. Why don't you work with 10 clients, show them 3 houses, you know where they want to be, and then fix up the house so that it's the way that they want it. And there's so many things that you can do with a home. In fact, we teach a lot of people, the more distressed the home is, which is your older housing stock in a lot of cases, and also a lot of the foreclosures. Unfortunately, in pretty much every neighborhood, there have been foreclosures, and many of those people, when they leave those homes, they tend to take things that are necessary for a home to
the stove, the cabinets,
toilets, fixtures, and all those things. So what this allows you to do is go in and buy those homes, because how many times have you walked in with a buyer and they say, oh, I love this home, but I don't like orange shade carpeting.
Or red or pink tile in the washroom.
Yes. So again, it's not only that we get to fix it the way that the homeowner wants it to be, but we also get to appraise it based on the after improved value. So if you think of it as you go to a closing and you have your bucket of money that you give to the seller so that it becomes your home, but then there's a whole other bucket of money that goes here, and we manage that through a construction escrow account to pay the contractor out through a supervised process to get the house completely done. So it protects the home buyer too. It's not like somebody buys a house, they hire a contractor, they get a $150,000 bid, hand them $75,000, and then pray that they continue to show up, and then it gets done. So we're very involved in the process after the closing too. So
okay, and if no one's ever heard of FHA, what exactly is FHA financing?
I think the FHA of old, when I first got into business, was we always thought first-time home buyers, bruised credit, all those things.
Okay.
Then for a short time, the rates were better, the mortgage insurance was lower, almost everybody was going with FHA. Now it's sort of somewhere in the middle. One of the big things that we offer is for owner-occupants for multi-unit buildings. It's still as little as 3.5% down, as long as it's owner-occupied. And again, that's 3.5% of your purchase price plus your renovation cost. So if you're buying a 4-unit building for $400,000, putting $100,000 into it, and you can do work on all the units, not just the owner-occupied, you're talking 3.5% of $500,000. So $17,000 to get into a 4-unit building.
And it's going to make you some money after you've done the renovations and rented it out some. I think that's very important to know for FHA financing, that you do have to be owner occupied, but it's as low as 3.5% down, like we said. It's fantastic. I know there was some of the great things that I took in course that I loved were, like, if it's a really big construction and they can't move in right away, what were some of the incentives they can get to kind of hold off their monthly payments and things like that?
Yes, as long as the budget and the loan amount, the loan limits will allow us to do that. We can finance up to 6 mortgage payments into the loan. So for instance, sometimes we'll have a family come in, and just the fact that they have a bunch of small kids and they need to redo the bathrooms and the kitchen and stuff. If it's a you know, a young couple or it's even one person, I'll go shower at the gym. I'll eat out for 2 months.
Yeah.
But if it's a family where they're trying to cook for their entire family and the kitchen is not going to be done for, you know, 2 to 3 months, then we can roll those mortgage payments in so that it's not free. It's being rolled into the loan.
It adds
because the whole idea here is, I always talk in terms of acquisition cost.
Okay.
You have a purchase price plus your renovation.
Okay.
Those two numbers, when you compare that with the after improved value, there needs to be a gap between those two. Otherwise, it's not worth the hassle.
Okay.
So, for instance, a single family home, you said average around here is about 250.
240, yeah.
So you go 240 and you put 50, let's say 60 into it to make it a good number. That's a $300,000 acquisition cost. You don't necessarily want that house to only be worth $300,000 because is that worth the hassle of a renovation loan? Maybe not, because they might be able to find a $300,000 home that meets their needs.
Okay.
But if we do 240 plus 60 and then the house appraises at 350, now you have someone with $50,000 worth of equity that only put down 3.5%. That allows them opportunities to refinance again to eliminate or reduce their mortgage insurance. And again, now we've got a first-time home buyer with some skin in the game, with some equity that allows them. And again, I think any of these neighborhoods that we're talking about, whether it's more of an up-and-coming like here or maybe a place that's a little more distressed, the key is to get families or individuals that are owner-occupants to own the majority of the homes, because that pride of ownership can turn a complete neighborhood around.
Absolutely, absolutely. Now, I know there are two forms of FHA 203K. There's Streamline and there's, what's the other one called?
There's a Streamline and a full.
And what are the
when we think the Streamline, you sort of want to think $35,000 or less for your construction budget, and you can't be doing like structural issues, which we could go into. But if you think about, you know, moving load-bearing walls or doing huge portions, some of that takes care of itself, because if you're doing large structural issues, you're going to get above $35,000 pretty quickly. The difference being is that Streamline is a little bit quicker. The contractor gets like half their money a few weeks after closing, and then they get their other half when the project closes out. Whereas the full, much like the Fannie Mae Homestyle, is there are going to be draws based on the amount of the construction budget that will be spaced out over the life of the construction. So that the contractor isn't going to get a huge sum of money up front. They're going to have to do some work, get some money, do some work, get some money, and keep that project going along.
Oh, that makes sense.
And we have construction companies and HUD consultants, depending on the type of loan, that actually oversee that entire process.
One of the first resistance I've gotten from buyers that are interested in this are like, is it going to take 4 months to close on this property? So what is the turnaround about for FHA financing? Are these type of 203K loans? Is it 30 to 45 days, like a normal kind of conventionally, or does it take months to kind of get it?
I'd like to say that where we're at with AmeriFirst Homeowner, we'll actually close a renovation loan sooner than many of the banks would be able to do just a straight up deal. If the credit portion really isn't a whole lot different, it's the choice of the contractor, because we are going through a third party, are going to vet that contractor and make sure that they're able to finance this kind of project and that they'll be able to see it through. So if a buyer comes to us and they've already got this appetite for renovation and they say, hey, I know who my contractors are going to be, then easily within 45 days we'll get to the closing table. Because remember, there's a closing, it's a one-time close.
Exactly.
But then the renovation starts, which is the construction portion. But there is only one loan. It's one closing, and then that second bucket of money gets allocated depending on the type of project.
Yeah, absolutely.
Yeah.
I think that's such a great incentive, and I know a lot of neighborhoods like Dunning and Irving Park and Portage Park, there's a lot of homes that are been on the market for months, and no one's seen the potential in them, and I think this gives people an idea of what you can really do with a home, walk in there and have a little more vision, and really build your own equity into your own pocket and really turn that around.
The more distress, the more opportunity for profit and equity, and when you hear mold, don't be afraid of mold.
Did you hear that one?
Don't be afraid of mold.
Don't be afraid of mold.
In this market, when a home is foreclosed on,
yes,
most of the banks shut off the utilities. When the utilities shut off, means the sump pump doesn't run.
That's right.
You have water, then you button it up, it's hot, it creates mold.
Yeah.
Mold, again, it can be remediated. It's a small part of that. you may be able to drive your purchase price way down. And again, what you're doing is you're creating that equity. You're taking someone with very little money out of their pocket and putting them in a position where they can have a ton of equity. And then these people go to work and say, hey, you know, I bought a 4-unit building for $10,000 out of my pocket, and the rent on the 3 units pays my mortgage payment. That kind of word initially is like, oh, that can't be true. It can't be done. But again, there are enough.
Free after that. Absolutely.
We have enough examples of that now that I think people are really believing that.
That's fantastic.
And that's the best testimonials, word of mouth from a friend.
Exactly, absolutely. So the question would be more like the contractors you would use, they have to be licensed and found through you, or can they work with their own contractors for the job, or? They
can choose their own contractors. Okay. Obviously, any work that needs to be licensed in Illinois, Chicago, or whatever municipality we're dealing with, they would have to have, whether it be roofing, plumbing. In different municipalities, they may have licensing requirements for general contractors, but they can certainly choose their own. We would never want them to feel like we're trying to make this a package deal for them. We have a large list of contractors that we believe in and we trust, but they may just be part of the puzzle and they can bring someone else in. But again, we want someone that this is the main focus of what they're doing.
Exactly.
We always get phone calls, oh, I have a dad or I have a cousin that does this. Well, come on. That's like when someone says, hey, I'm going to be moving soon. Will you help me move? Well, when they call us to actually help them move, we usually can find something else to do, right?
Yeah, absolutely.
And it's the same thing when you have someone else that's doing it as a favor and not really getting paid. That borders on a self-help, and that's not really that project is going to go way to the bottom of the totem pole and not get done. So we're looking. We want them to treat it almost as if they're building their own home from scratch. Okay. We want someone that's going to be on the job most every day to get it done.
What would you say in the credit area for the underwriting these days? Is it a lot of challenges facing your credit scores, or are any of those things a major factor in getting approval?
You know, I don't really see that the guidelines have changed that much. You know, I think the stated income, some of the things that maybe didn't make sense years ago when we created our bubble are gone. I think that everyone could agree that getting a mortgage for a self-employed borrower has become very difficult because of the way that most people write off their income on their tax return. That probably is a lot more difficult because there really is no plan B for someone that makes a ton of money and writes it all off. But as far as credit scores, I mean, there's common sense applied in this too, especially on the government loans. I mean, someone could have had a catastrophic thing happen to them. In fact, maybe even less than 3 years out of foreclosure, and maybe they had a massive heart attack, or their spouse died, or they lost their job. We actually have programs now at regular FHA rates that will allow those people to go in and buy a home with an exception. There's a little bit more work to be done, but it's not like we're raising their interest rate a point. It's still based on someone on their overall profile and credit score. But it's a great program, and both, I think, FHA and Fannie and Freddie have all started to apply a little bit of common sense, because who doesn't know someone that lost their job?
Well, no, especially in the crash, people lose their jobs, their houses, and it's been rough.
And a lot of them are employed again, but they're underemployed.
Yeah, exactly.
Sometimes underemployed could almost be worse than unemployed.
Exactly. And now, would you say that these loans are primarily for single-family homes, or can they be used for condos?
Condominiums are tough with FHA.
They are tough.
The reason being, again, is that many of the condominiums had their budgetary problems. When you have a building with 100 units and 20 people foreclosed on, it's not just those 20 loans that went bad, it's 20 less people paying into the association, which affects your budget.
Absolutely.
So, and there are some laws there where those condo association fees sort of just don't get paid, and then someone has to pay those when they get to the closing table. But it could be 2-3 years before those are sold. So condominiums, there are still some that are FHA approved. That's on the HUD website.
And we actually have the link now with the NMLS, and we can actually populate just the ones that are approved for FHA.
Yeah, and that's a huge help. There is talk that the spot loans may be coming back, which allow you to get an individual condo approved, because maybe they meet all the requirements of HUD, but it's only 4 to 6 units, and they don't want to pay that incredible amount of money to keep their FHA certification, but they meet the budget, they meet the reserves, they have the owner occupancy. That's the big thing.
Yeah, that is.
So if that comes back through HUD, that was a huge thing, because right now it's pretty costly through some of the programs to get an entire association not only reapproved but recertified every year. There has to be someone that will absorb those costs to get that back on the HUD approved status. So condominiums, you have to be careful, and they also, you know, a lot of times people will call me and say, "Oh, it's a townhome." Well, I always use the analogy: a townhome is like telling me you're going to buy a Cape Cod versus a ranch. It's a type of a structure. From a lending standpoint, we're either lending on a condominium where you do not own the land below your property, or we're lending on a planned unit development. Which could be a townhome structure, but you could have townhome structures that are actually deeded as condominiums because they have some shared elements, and it's really how the deeding goes. So a planned unit development is much easier to get financing on than a condominium, especially when you're talking government loans.
That's good to know. I mean, there's so many single family homes out there for people, so it should just really show some love too, and these loans really provide that, so I think it's fantastic. What is the other, Homestyle?
The Homestyle,
Should we say a little bit about that?
For either of these loans, the Homestyle or the FHA 203K, we have also a contingency reserve. You think of when you have a savings account, you have an emergency account.
Okay,
right?
that's important to know. Yes.
So your air conditioner goes out, you don't want to necessarily have to put it on a credit card. Same thing with the construction budget. So if the utilities are off on a government loan, we typically always hold 15%. So if you had a $100,000 budget, we would put $15,000 as part of your construction budget as your contingency/emergency account. So
and that's going to be something that they're going to really be concerned about. Like, what if this home, they're giving me this budget, but what if it doesn't cover if something major comes up? Right. So you have that contingency percentage for the back end.
Well, if the utilities are off, the water is not turned on, the electric's not turned on. One, you don't know what's causing your water. Second of all, you don't know if the water pipes were frozen. You turn them on and it's, you know, Niagara or a geyser. You have
all
an
the
issue.
walls are coming from everywhere.
So we have that there. I mean, in a perfect world, we wouldn't want to access that. Just like in a perfect world, you wouldn't want to access your emergency account.
Absolutely.
And that money, if it's not used, just gets applied back on the principal of the loan when they're completed.
That's fantastic.
Typically, it's 10% of your budget.
Okay.
But again, if we have something that's a little bit larger that could have an issue, then we can set that a little bit higher to protect not only us, but really to protect the buyer.
Absolutely. So that was for primarily FHA, but there are the Homestyle.
Oh, I'm sorry. Yes, the Homestyle is just
another form of renovation loan is Homestyle, and
it's the Fannie Mae Homestyle. Again, right now we can do single family for investors.
Single family for investors.
But 1 to 4 units for owner occupants. 50% of the after improved value can be your budget. So if you bought a home for $200,000 and the after improved value was $300,000, you would be limited to a $150,000 budget. It was probably let's say $400,000 after improved value. Your renovation budget would be limited to that $200,000, which is 50% of your after improved value. That product is very similar to the full FHA 203K. However, the loan limits are the conforming loan limits. So instead of being limited to, I believe it's a $365,000 for the FHA, it's $417. So I have like 2 transactions this month that difference made us choose the Homestyle over the FHA 203K.
Really? Okay.
It is an absolutely great tool. It's not for everyone.
No, it's not for everyone. Absolutely.
If you don't have an appetite for doing renovation, and you're going to have to oversee it some. It's not a perfect world where you give someone the combo and they come in and make the house perfectly for you. But if you're looking for a way to put in limited money, but to create equity in the home that you love instead of one that you're settling for. This is the product to do it.
Yeah, and I personally love seeing transformation, and that's why I feel like I'm kind of niching the single family homes and the rehab loans, because it's really, there's so much to be done, and I can share pictures of other homes in the neighborhood, and some that have closed that could have really used it, and they're doing the renovations out of pocket, and they should have known about this. You know?
Cash is king.
Yeah,
that's what I tell people. Now, if someone is putting down 20-30% down on their home and they got $300,000 in reserves. Hey, that's not someone that needs financing for this. But we do a lot of refinances on these too, because people really don't want to move. They're in the school district they want. Maybe they had a couple children and they need to add a bedroom, or they need to add a bathroom, or in many cases we're adding second floors or finishing basements and things like that. But based on their current equity, they don't have enough money to access this, so they would have to go put it on a credit card. Remember, we're lending on the after improved value.
I'm looking forward to getting some of these projects done and having you see the before and after and loving your home and making it your own. So if someone wanted to reach out to you, what would be your contact information? I'll definitely add it at the bottom of this video, but what's your email and phone number? Is that how would they reach you out that way? And
usually easiest is to catch me, because my mission is to go out and educate as many realtors.
So that's your mission
as possible. So my cell phone is 630-244-3007, and it's Ktally, Tally, at amerifirst.com. And visit our corporate website is focused on renovation. So if you go to www.amerifirst.com, you will find everything that you want to know, not only about these renovation loans, but about, there are so many educational materials geared towards first-time home buyers, and the entire process of making this educational, not salesy.